Are you ready?
Yeah, baby.
Are you ready?
I'm always ready.
Hit it. I saw you were with them last night. I saw you were with them last night.
Yeah, that's Bill. That is not Billy D. That's Engaging Time, coming to you at a venue near you. First stop, Fairmont Shores, Lake Villa, Fox Lake, Illinois. Looking forward to a 3-hour gig. Hopefully you'll be all out there to root me on or throw me a tomato, one of the two. Bring your quarters, prefer 20s in my little bucket, but if you bring a quarter, that's fine. That'll tell me something, I think. Sean, what do you think? I think if they throw a penny,
tomatoes,
if they throw a tomato,
tomatoes.
yeah, if they throw a penny in my bucket, that's going to tell me something. So hopefully I don't see who does that. Anyway, welcome back, ladies and gentlemen. This is 101.5 FM WLCB, Slade's Corner, Wisconsin. I'm here with the illustrious, effervescent, always on time, Sean Hauser.
That's me. I'm illustrious and bubbly. People say that. Bubbly is all day long.
Absolutely. Absolutely. So we're going to get into 401k versus life insurance. Now, for those of you who have a closed mind, open your mind a little bit, because these are just numbers and they're projections, but they're the same projections. So in a 401k, we're going to drop $20,000 a year. That roughly works out to about $1,666 a month. We're going to do the same thing in a life insurance policy, $20,000 a year, $1,666 a month. We're going to do that for and by the way, this person is 42 years old, Sean. So, so we're starting off with a 42, somebody who is a little bit more seasoned, a little bit more savvy. Maybe he's had his kids already, and he's, they're in their teenage years or whatever. But he's making some money, and he's looking for different ways to set aside the money. And so we're going to do this until age 67, which is 25 years. Why did I pick 67? So why do you think I picked 67, Sean?
That's the full retirement age for somebody who's...
Yeah, that's correct. For the moment, that's the full retirement age. Anybody,
ding, 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 ding.
Anybody born after 1960, your full Social Security retirement age is age 67. If you decide to take your Social Security before your full retirement age, you will absolutely not only take a haircut on your income, but you'll be limited as to what you can make insofar as your earned income until you get past 67. And by the way, I heard this yesterday, and I didn't know this, Sean. The income threshold, simple numbers here, is $25,000, and it was set back in the 1980s. It has never been adjusted for inflation, ever. It's been $25,000 minimum earned income for a single person since they revised the Social Security thing back in, I think, 82 or 83 or something like that with Tip O'Neill and Ronald Reagan.
What does that mean?
It has never been adjusted for inflation, so that the base salary for a single person that you can make as earned income before they start taking the Social Security money away from you, if you take it too early, is $25,000 a year. If they had adjusted that and pushed that up for adjusting it for inflation, in today's dollars, a single person could make $80,000 of your earned income and still take his Social Security without worrying about a penalty. But they've never done that before. So there is a possibility, because it's on the radar now. In fact, Trump was just out there talking about not taxing Social Security if you're going to take it. So I suspect that's going to become an issue for the politicians to have to wrestle with regard to Social Security. And they do this all in the face of the fact that Social Security and Medicare is going broke. So we'll see how the smart people in Washington are going to work this out. But
he must have been in Ohio today where recreational marijuana was just made legal, because if you don't tax Social Security, which, hey, it sounds like great on paper, but right now we're not taking in enough revenue for the deficit or Social Security, et cetera.
Yeah, you're not
It
wrong.
wouldn't help Social Security, but we're not taking in enough revenue as the government to be able to say, yeah, we don't need any more of that revenue from Social Security, too. I understand it's not a massive amount of money, but how can you keep giving tax breaks, and unless you're cutting spending, and there are certain things we'd never cut spending on in this country, such as defense and some other things, how can we keep giving away revenue? I mean, that's how you go out of business as a small business owner or as a large business owner.
Yeah. I think, honestly, Sean...
That's another show.
It is. I'll say this because it came up in a conversation today. The biggest line item in a corporate arrangement, whether it's the government or a private sector, is what, do you think? The biggest line item for a company. Yeah.
Probably debt service.
Nope. Payroll.
Wages?
Yep.
Payroll? Okay,
Payroll.
that was my other one.
Yep. So my attitude would be you have to have a flat cut of every agency, defense included, across the board of 20%. There's too much fat. You get rid of the high rollers in government that are making $150,000 pushing paper. I'm sorry, but that's what corporations have to do. There's a lot of politicians in Washington that would say, we're just like the government. We're like boards of directors. Well, these people would be in jail if they ran a corporation this way. So you're not wrong about what you just said. You're absolutely spot on. But it's going to resonate with a lot of people who are saying, yeah, I paid in for that for 40 years, and it's a tax on a tax, and I shouldn't have to do that. It's going to resonate. Whether or not we pass Mathematics 101 or not is a separate issue.
Well, sure. It's just like when you say, I'll make sure that Social Security is always going to be there, Medicare will always be there. You got to pay for that.
Yeah.
Right?
Yeah.
You got to raise, and they talk about cutting taxes and raising tariffs and all these other things, but yeah, we're getting off topic.
Yep. All right, so topic, putting 20 grand in, 401k, putting 20 grand in, life insurance policy. Over 25 years, that's $500,000. So that's your net investment after 25 years. Based on a 6% return, and I said 6% in a 401k, which is probably a reasonable rate of return over the long haul, you've got $1.139 million. $1.139 million. Congratulations, you're a millionaire. Awesome. Good job. I used an indexed universal life policy to do this, not a whole life policy, because I have more flexibility in premium and insofar as how I can fund a life insurance policy, and I'm tied to indexes in the stock market without losing any money. So if I'm tied to the S&P 500 or a bazillion other indexes, if the index goes up, I get to play. If the index goes down like it did yesterday, for example, I don't lose a penny. So I'm never going to be in a loss position no matter what happens. In a 401k, you are absolutely subject to market risk. No two ways about it. If you're invested, what goes up will go down. It will go back up again. And as I told my kids over the weekend, I said, at your age, let the stock market go to zero. What do you guys care? You don't need the money until 40 years from now. You're buying a lot more shares of stock when the stock price goes from $10 down to $2, and then when you get to be my age, now you don't want that to happen, so you're going to want to be more diversified. So the life insurance policy, based on an overall 6% rate of return, which is conservative, Sean. The company I used here is using 7.5 right now, not 6, because that's what their 10-year rolling average has been doing. 10-year rolling average. They're at 1.16 million. So I outperformed the policy. Both grew tax deferred. I have $30,000 more in my life insurance policy than I do in my 401k. The life insurance policy grew tax deferred. The 401k grew tax deferred. Now, one other thing here, How much life insurance did I buy when I bought the life insurance policy? Well, I had to buy $311,000 in death benefit. So if I committed to $20,000 and I died the next year, my benefactors would get $311,000 income tax free. What would the person get if they put $20,000 into a 401k? Whatever the 401k was worth at that time. Could be 20, could be 21, 22, could be 15, depending on what happens in the market. And the 401k is all taxable. The life insurance policy is income tax free. So now, 25 years later, it's time to turn on the income. What are my options? So if I don't believe in annuities, and I'm using the 5% rule, not the 4% rule, folks. 5% rule says I'm going to assume a 5% rate of return, and I'm going to take 5% out. That means my principal should pretty much stay the same, but, ebb and flows and all of that. I'm going to take 5% out, and let's see what happens. The 5% rule based on $1.139 million, I'm going to get almost $57,000 a year. Now that's gross. That's not net. I have to pay taxes on that. Based on the taxes and using 20% as a flat number between state and federal tax, I'm going to pay $11,000 in taxes. So my net gross income is now not $57,000. It's $45,500. My net monthly check goes from $4,800 down to $3,800. So I'm down $1,000 a month roughly, net. I'm not taking into account Social Security. This is just 401k versus life insurance. In the life insurance policy, if I'm going to take money out of the life insurance policy, and this is where we blow away the 401k, folks, you can take a loan against the life insurance policy income tax free. And depending on the rate of return of that money, I can get anywhere from $47,000 a year tax free to upwards of $105,000 income tax free. Income tax free, and I still have a death benefit there if I die prematurely. Now, there is an oh by the way clause here that you have to pay attention to, actually two. First, putting $20,000 away into a 401k is a lot of money. No two ways about it. It's a lot of money. If something happens in your life where you have to stop in the 401k, you can. The life insurance policy is a commitment. You can't just stop and start it. So these are for savvy customers, savvy clients, and you can use $10,000 a year, which is a little bit more affordable in all honesty. A lot of people can afford $1,000 a month. But I use 20 to make the numbers look good, and this is a person who's making a decent change, blah, blah, blah. This is a commitment. You can't just stop and start a life insurance policy. But if you understand those things and you get to the part where I'm going to start pulling the money out income tax free, you're taking a loan against the policy. If you pay attention and you get the right advice and counsel from the life insurance policy, you will still have a death benefit at the end of the rainbow, and you will never have to worry about having your life insurance company become what's called a tax bomb, which means in English, if you took too much money out too fast and the interest charges overran the cost of the life insurance, because it's still a life insurance policy, it now becomes a tax bomb. And that could be terrible. So what if you want to avoid that, and you want a guarantee income, and you don't want to have to worry about the tax bomb, and you're okay with paying some income taxes? Sean, I'm going to take the $1 million that I had, $1.1 million, drop it into an annuity. It's called a 1035 exchange. I can do that income tax free. I'm moving the cash value of the life insurance policy into an annuity. Now, there's some underwriting things I'm not going to take into account. We're making some assumptions in here that this guy can do this. So I now have $1.1 million, and I'm going to turn on the income immediately. And usually immediately means within the first 30 days of the policy. No problem. At age 67, I can get $83,000 a year. Now, remember what I said. I can get $56,000, almost $57,000 a year in my 401k, but it's income taxable. I just dropped this into an annuity, and I can get $83,642 a year for the rest of my life and never, underscore the word, never run out of money. Never run out of income, be clear. Never run out of income. If I live to 115, the insurance company has guaranteed me that $83,000 a year, every year, no matter what. Now, let's say that I want the possibility of getting a raise. Same annuity, same drop, but this time I'm going to take $72,000. Now, the raise comes with some assumptions. It assumes that the market is going to go up, and if in certain policies, if the market goes up, you can get a raise in your income. So in this illustration, I start out at $72,000, and by year 8, everything being equal, I'm at $83,000, and by year 20, Sean, I'm now making $106,000 because I got a raise. Now the raise wasn't significant; it was a couple percentage points every year, but it still went up. Is that possible? Yes. Is it likely? No. Be perfectly honest, because markets go up and down, and if the market does 0 or less, you're not going to get a raise that year. But you do have the option of being able to buy into an annuity that allows you to get a raise every year and never run out of income. And it's income, folks, that drives the retirement wagon, not the pool of money that you have. The pool of money, in my humble opinion, is an ego thing. Give yourself a pat on the back that you put $1 or $2 or $3 or $4 million away. That's awesome. Have you figured out how to unroll that? Have you figured out the tax cost of that? Keep in mind that a 401k is completely taxable to you and or your benefactors unless you convert it from a regular 401k IRA, if you will, to a Roth. But you're still going to pay taxes on it. You're still going to pay. And if you don't annuitize that money, you're still potentially going to run out of money. Draft that money into an annuity. The contract will guarantee you an income for life. Now, by doing a 1035 exchange, I know I'm into the weeds here a little bit, but by doing a 1035 exchange, you lose the life insurance policy. So, part of this 1035 exchange, part of this annuity now becomes income taxable, but not all of it. You put in $500,000, so that's your basis, that's your floor. It made $661,000 in interest over the 25 years. So about 57% of the money that was dropped in there is taxable. So let's run the taxes. Based on an $83,000 a year income, I'm going to end up paying $9,500 roughly in income taxes, which means my net check after taxes is $73,768 a year, as opposed to $45,000 a year. So, Sean, I have now established the fact, numbers being equal, everything being equal, done correctly, understanding the moving parts, a life insurance policy over a period of time, and it's got to be a long period of time, folks. It can't be, it's not a 10-year break, 10 years is break even in the life insurance world. This is a 20, 25, 30-year commitment. But if it's done right, you will set yourself up for a very nice retirement without the burden of having to pay taxes. And you still may have a life insurance policy on the back end of it where whatever is left in that policy gets distributed to your family income tax free. It works. Now, for those listeners who are going through apoplexy right now going, oh, that's not possible. Yes, it is. That's okay if you don't want to believe it. It's okay.
Well, I think, and in this case, we would certainly recommend that anybody listening speak to their
Tax advisor.
tax advisor.
Yep. Make
their
sure you
accountant.
absolutely do your due diligence. Yep.
And the other thing is, we just went through an idea on the air, and it makes sense, right? You put $20,000 in a year to a 401k versus a life insurance policy, and you've called out some of the necessary requirements. This was for a guy that was 42. I'm sitting here at 54. I don't have enough time, maybe, okay? And the other thing is that you have to do it right. You can't just go to insurancers.com, buy one of these universal life policies. You got to have somebody that can walk you through each step and check everything.
Yes, exactly right.
You have proven the point that, and what's interesting is I'm in the market shopping for people to provide financial advice, and everybody goes, oh yeah, we'll create your personal pension with a life insurance plan, and you'll blah blah blah. And I'm like, what do you mean personal pension? I thought the government or the railroads had to give me one of those, and there's all these names. So make sure you get that advice from someone who knows what they're doing.
Yeah, and personal pension, folks, is nothing more. It's code for an overfunded life insurance policy. It's not complicated. That's what it is. It's an overfunded life insurance policy, and it's not for the faint of heart. And I come back, my core here is still it's life insurance first. So if your goal is to buy life insurance to protect your family, it doesn't matter what kind. Buy the right amount. If you need $1 million, get $1 million. If you only need $500,000, get $500,000. If you need $4 million because of where you are in your life and the things that you're doing, how much money you're making, get $4 million. And then decide what kind you're going to buy. But understand that if you buy term ends, and then you have to redo it all over again. If you do a blend of term and permanent, and you can afford to do that, that's going to be a benefactor to you and your family long term. Especially if you're doing it in the younger years. If you wait till you're Sean's age or my age, it's a car payment, maybe two, depending on your health and circumstances. So these are the kind of things that are not meant for the average person making 50 or 100 grand. Admittedly, even 100 grand a year, given the state of affairs of our country right now and cost of the living and this and that. Sally and I just went to the grocery store yesterday, and it was yesterday on Sunday, and I think we spent like $238. Now, full disclosure, I bought some shoes. That was $70. But we didn't buy hardly anything, and certainly we only bought ribs for meat. The rest of it was stuff. We didn't even get lunch meat.
It's a religious experience.
Yeah,
and it just
it's so you have to go in this with your eyes wide open. Life insurance agents that are going to push the stuff on you without doing their due diligence of asking you a lot of questions up front. Just buyer beware. It's not that they're bad people, but if they're living on commission, folks, they can't survive selling term insurance. They can't survive selling just investments unless you're going to drop 100 grand into their lap every time you see them. It's not going to happen. I was just reading an article over the weekend. The attrition rate in the insurance industry overall is 95%.
Is that from day one?
95, yes, 95%. Now, knock on wood, I've been lucky. I'm the anomaly of that. I've been doing this for 34 years. Now, I don't just sell life insurance. I do corporate benefits, which is a totally different thing. But I'll also say, in the corporate benefit world, the income is good, but if you lose a big account, it can really hurt, first. Second, it is hugely more complicated now than it was even 10 years ago. Let's say 12 years ago. Before the advent of the Affordable Care Act, you only had to deal with ERISA and COBRA and maybe a couple of other things. The moment the Affordable Care Act was passed, all kinds of other rules became a part of the ledger. So on any given day, as I like to say, for people that do what I do for a living, We're practicing insurance, law, tax law, and accounting, depending on your question. How do I know? Well, let's say I sell you, Sean, a health savings account compatible health plan.
Oh, yeah.
All right?
Yep.
Now, I use the word compatible for a reason. You cannot have any copays. You have to have a deductible up front. And the market, by and large, is not selling $2,000 deductibles. The insurance companies make them cost prohibitive. So we're selling, with a smile, $5,000 deductibles. And then we have to tell somebody, oh, that's an affordable health care plan with an out-of-pocket of $9,000. And the best thing you can do, Sean, is put $8,000 away for you and your family into an HSA account or a bank account that allows you to help pay for some of your health care. And they look at you cross-eyed with fire coming out of their eyes, going, yeah, okay, and? And the benefit is? So all of this kind of comes together. Whether you're employed, whether you're self-employed, these kind of concepts that we talked about tonight work. They do work, but they're not for the faint of heart. They're for the savvy investor and people who understand them, and for people particularly who can afford them. And with that, it's 7 o'clock, and it's time to go. Sean, any questions?
I wouldn't know where to start, Bill. We'll catch up next week.
I will text you later. You have a great week. Enjoy your week, everybody. This is your Insurance Corner at 101.5 FM WLCB. See you next week. Oh, you know what? I might not be here next week. I'll let you know. Have a great night, everybody.